Okay, would like to take this opportunity to welcome everyone to today's sneak preview top 10 stock picks event. It's August 10th, 2020. You can have Tom Bowley joining us in just a minute. You got John Hopkins here. A lot to cover, so I'm just going to be very, very brief. First, I want to welcome everyone tonight, all of our new trial members. Thank you for taking the opportunity to give us a shot here. Of course, our seasoned veterans who've been with us for many years, thank you for taking the time to stop by as well. Just a couple of quick housekeeping items. This event, like all of our webinars, will be recorded. So if for some reason you are unable to stick around for the whole thing, don't worry about it. We'll make sure you get a copy. Plus, you'll be able to listen to it at your leisure. And then, of course, after tonight's event, Tom will be talking about, obviously, the top 10 stock pick event that will occur on August 19th. Hard to believe that the quarter has gone by as quickly as it has. Anyways, like I said, you get a copy of this recording once it's ready to go. And speaking of ready to go, I'm going to see if Tom's ready to go.
I am. How are you doing, John?
I'm doing good. Like I said, I can't believe how quickly these quarters go by. Seems like we just were having this, last time around.
Yeah, I think as I get older, they go by faster and faster.
That's true too. I can attest to that. Anyways, I'm going to just turn it over to you.
Sounds good. Yeah, I remember back in school, it seemed like a school year. My gosh, from start to finish, seemed like I would never get there. I remember I was a big golfer in school, so I was always really excited about the spring season. So I'd get out and play golf and compete and on. It seemed like the quarter, that time of the school year would never arrive. Now, as you've gotten older, probably everybody can relate. Seems like years go by much faster than they used to. But we got a lot to go over tonight, so I want to go ahead and get into this. Why don't we go ahead and go through the agenda? Just a brief introduction. John, welcomed everybody. I would go ahead and share in that as well. I want to welcome all of you. Really appreciate you taking the time out to stop by. Certainly want to thank all of our members that have supported us over the years, some of which have been with us since the very beginning back in 2004. But many of you have joined since I returned to EarningsBeats exactly 1 year ago today. That was when the announcement was made over at Stock Charts. It was August 10th of 2019. So it's been 1 year. And as a result, we're going to have a special. I'll talk about that in just a minute. Then we'll go into a brief market update. This really isn't an event to talk about the market, but I want to give you kind of my take on the market and why I remain very bullish. And that'll be very brief. And then we'll get into portfolio results and summary. The sector industry group relative strength. This is a chart list that I use all the time. It's just very quick and very easy to interpret. How are industry groups doing relative to the S&P 500? Because if I'm trying to outperform the S&P 500, I want to know where the strength is. Then we'll get into portfolio design strategy. And then, as John mentioned, the draft, which is actually next Wednesday. So mark your calendar. Or is it? No, it's next. Next Wednesday. So mark your calendar. Next Wednesday. That is a members only event. But that's when we will be announcing the 10 stocks that go into each of our 4 portfolios. And I think our portfolios, their performance kind of speak for themselves over the past, well, really since the inception. I also want to mention that this Saturday, this will be another free event coming up on Saturday. And the purpose of this event on Saturday is to discuss all of the changes that we've made over the last year. All the chart lists, all the scanning strategies, everything that we've done, the portfolios to a lesser extent, since we have this event and then also the top 10 draft next Wednesday. But I want to just go through and make sure everyone understands, because we have added so many products and we do so much research here at EarningsBeats. Sometimes it's hard to get all the research communicated effectively. to all of our members to make sure everyone understands exactly what these various products are, how we use them, and how maybe they can improve everyone's results. So that is going to be an event on Saturday at 2 p.m. And essentially, it's really just kind of getting under the hood of EarningsBeats and looking at our research engine, and trying to help explain to everybody what our chart lists are and some of the things that you should be thinking about. I'll be going through scans, showing you how to use various scans and some different techniques to try to find great trading candidates. There will be a lot going on. And again, that's going to be free. I want everybody to understand what we do at EarningsBeats. I know that our members probably have a lot of questions, but certainly those of you who've never tried our service may have some questions or may be interested in exactly what we do. So that's going to be for Saturday at 2 o'clock Eastern. If you can't make it, if you're part of the EarningsBeats community, which you will be if you're part of this webinar, you're either a paid member, you're on the EarningsBeats Digest newsletter, which is a free newsletter. And if you're neither one of those, we'll make sure we get you added to the free newsletter. No credit card required. You can unsubscribe at any time. Just want to make sure that you're part of our community, and hopefully we can help you navigate the market. So the draft is next Wednesday. Got another special event coming up this Saturday. Mark your calendar for that. But let's go ahead and jump in and talk a little bit about what's been going on, and exactly what these portfolios are all about. So I'm going to start first with an article I wrote over at Stock Charts 1 year ago. And this is the article that I wrote in my Trading Places blog. This is when I first announced that I was going to come back to EarningsBeats. And this was back on August 10th, 2019. So 1 year ago today. It was scary at the time. Didn't exactly know what to expect, but I had a couple of things that I really had on my mind that I wanted to do when I made this decision. Number one is I wanted to be able to provide a lot more in-depth information and knowledge and research and so forth through the chart lists. And we've worked very closely with Stock Charts over the past year to make that system better and better. For those of you that started out with us a year ago when I came over to EarningsBeats, you'll probably recall that our chart list, when we would finish a chart list, we had to send them out one chart list at a time. We had to share our chart list with one member at a time. Type in the member email address, the user ID at Stock Charts, and then we'd send you the chart. And you had to download it into your account. You had to go through this process. So we had to do it one by one. Now we can actually provide links to our members one time. We just send out the link one time and everybody can go in. And if you're at least an extra member or above at Stock Charts, all of our research you can download into your account literally in seconds. It's really a cool system that's been developed over the last year. But that was kind of a vision a year ago. Had no idea how all that was going to go, but it's really worked out pretty well. The other thing, it's been great working with my daughter, Erin, who is a CPA as well. And she left public accounting and started working for us actually a little over a year ago. She actually came on board to help us with a few little minor projects. I think it was in June of 2019. So this was before any of this had even been considered. And so as it turns out, it just was, very, I guess we were very lucky in that we were able to bring her on right before I made this switch. But it was not an easy decision. I love Stock Charts. I love what they do. The platform they gave me has been awesome. It was then, still is, and I love to teach. I love to educate, and that's been a great platform for me to do that. But one of the things that I'd mentioned in here last year was this was one of the reasons I wanted to do this. I had started developing these portfolios, and you can see the portfolios were actually performing pretty well versus the S&P 500 at that time. And this last year, they've completely just blown it away. Income portfolio, in all fairness, is actually below the S&P 500 since inception. But the aggressive portfolio and the model portfolio absolutely have just blown the S&P 500 away. and we're really proud of that at EarningsBeats. So that's what this whole event tonight is really designed to talk about: these portfolios, how we construct them, what we look for, our methodology, our system. That's what we're going to get into here in just a couple minutes. But I do want to share one thing. Since this is my anniversary, 1-year anniversary, I want to bring back the spring special that we had back in May that was very popular. A lot of members took us up on this offer. And so between now and Saturday, so the next 5 days, this event and Saturday's event, you'll have an opportunity to sign up for an annual membership with our best deal ever. So just going through, at our website, if you click on webinar special at the top, it will describe basically what you're getting and what the membership includes. I do a daily market report every day, the 4 portfolios. Not only do you get the stocks, but then I also have chart lists for each portfolio that you can download right into your account if you want them. So you don't have to type in anything, create anything in your stock charts account. If you're not a stock charts member, it doesn't mean you can't get this information. You just have to view the information one chart at a time. Obviously, you can't download it because you're not a member at Stock Charts. So you want to make sure, and Stock Charts has a 30-day free trial, by the way. So this would be a great time if you're a trial member here at EarningsBeats and you're not a trial member at Stock Charts, try it. Combine the two for 30 days at no cost and just tell me after 30 days what you think. I think you'll be pleasantly surprised. But all of these portfolios are in chart lists, separate chart lists that can be downloaded. And then here are all the organized chart lists that we do. When I talk about research, our research, this is basically our research engine. Strong earnings chart list, 326 charts. These companies have already been vetted. I've already gone over to Zacks. I've looked through thousands of companies during earnings season to narrow it down to the companies that beat top line or revenue estimates and beat bottom line or earnings per share estimates, Wall Street's estimates. If a company beat both, and a company is liquid, and a company has a good technical chart, the technicals look pretty good, then they get added to the strong earnings chart list. So when you download the strong earnings chart list into your account, these 326 companies that are currently on there, these 326 charts, these are annotated where I put on some of the key support levels that I would be watching on pullbacks. All of this gets downloaded into your account instantaneously. Strong future earnings chart list. So what I did is I went to look for some of the top technical performing stocks, found which ones were some of the best relative performers in the market, and then I ran a scan against both the strong earnings and the strong future earnings to see which companies were on both lists. And if they were on both lists, I subtracted them off of the strong future earnings because they were already on strong earnings. So what these two lists do, one tells us which companies have been really strong that have reported great results, better than expected results, and the other one is made up of companies that may not have reported great results, but for whatever reason, Wall Street still loves them. They're showing great relative strength. That's another 304 charts. So right there, you've got 630 charts of some of the best stocks to be thinking about trading. Then we have a strong AD and a weak AD chart list. That's AD is accumulation distribution. And these acronyms that I've put in parentheses, this is just what we use to shorten it. So, you know, our members, as they get used to it, then they'll know what we're talking about. So SECL, strong earnings, SFECL, strong future earnings, blah, blah, blah. But the AD chart lists were developed back in April, and I have to say these were probably the 2 best chart lists we put together. And it was simply based on the research that we had done during the pandemic, during March and into early April. We saw a lot of companies all companies were going down, but many companies were being accumulated based on their rising AD lines, accumulation distribution lines, while other companies were gapping down and kept going lower, and they had weak AD lines. And so we separated them into the best, the strongest AD chart list and the weakest AD chart list. So for several months, the strong AD chart list outperformed the weak AD chart list by a country mile. And so if you wanted to trade on the long side, 368 charts here you could use to consider trading. If you wanted to trade on the short side, and I'm not a fan of shorting in a secular bull market, and even back in March, I said we were in a secular bull market. I never lost sight of the long-term secular bull market. And that helped throughout this pandemic. And as the market rebounded, everyone else was thinking we can't go higher. I was expecting to go higher. That wasn't to say that we couldn't go back down for a double bottom. We never did. But I never said we couldn't go back down. I was just saying longer term, I remained very bullish. Once we got through this pandemic, we would return back to new highs. And that's what we've been seeing. Recently, we added a new chart list, raised guidance, because members had asked me, well, do you ever consider the guidance? You know, do you just look at companies that are beating revenue and earnings estimates, or do you consider companies that are guiding higher? You know, in the past, I hadn't really looked at guiding. Why? Because the problem with raised guidance is some companies just missed their last report, you know, just missed their last estimate, and yet they're raising guidance. How much are you going to trust that? You know, if somebody's supposed to come over and mow your lawn, they schedule it for Tuesday and they don't show up, and then they say, well, I'll be there on Thursday. You might start to think, well, maybe they're not going to show up on Thursday either. And so raised guidance is great, but I'd feel better a company that is beating estimates and raising guidance than a company that's falling short and raising guidance, because they overpromised last time. Maybe this raised guidance is just overpromising again. Anyhow, we go through the raised guidance and we put the charts on there, show you exactly where they raised guidance on the chart, point an arrow right at it so you can see the reaction. And then we look for key support levels on those charts as well. And then the short squeeze chart list, which is very popular. This is just the highest shorted stocks in terms of short percentage of float. 92 highest short percentage of float stocks in the market. And many of these stocks are not stocks you want to trade on the long side. They are shorted for a very good reason. But some of them, the market just gets it wrong, and the short sellers get it wrong. And it's good to know when we see it on our short squeeze chart list that a stock is breaking out, especially if it's showing good relative strength. We've had many that have absolutely just exploded to the upside. I've written about a number of them in my blog articles. I talked about Tesla. I talked about Peloton. I talked about Ollie's. I talked about Charter Communications, CHTR. I've talked about Bed Bath & Beyond. There are many stocks that have performed extremely well, but you got to wait. You got to be patient. You got to pick your spots. Anyhow, scanning strategies, industry group relative strength chart list, and all these webinars. This is all part of your membership with us here at EarningsBeats. I will point out, and I'm going to be going over this industry group relative strength chart list later in this presentation. This particular chart list, to download it into your account, requires an annual membership here at EarningsBeats. It's 104 industry groups. Once you get this, it doesn't change. All these other chart lists change over time. So having them is great for a while, but as more earnings come out, the strong earnings chart list, it changes. It's a revolving chart list. So if you have this chart list as a trial member, 3 months later, it's going to be worthless. This industry group relative strength chart list is worth a mint, and it lasts forever. So we ask that you commit to our service for a year before we send that off to you. And then, of course, lots of webinars. Now, the reason I bring all this up is that normally our service, once you get past your 30-day trial, is $97 a month. So if you were to just stick around for 12 months and pay us $97 a month, you'd pay $11.64. Well, we have a anniversary special. This is a 1-year anniversary special. It's only going to be good through August 15th, which is this Saturday. So you got 5 days to think about it. And you're going to get not only the 12 months, but we're going to throw in 2-month membership bonus. So it's going to be the same as the spring special we had back in May. So now you can get 14 months for the price of $697. Now you can see that if you did the 12 months and then you had to pay another extra 2 months for your bonus, the total you would pay would be $13.58. If you sign up between now and Saturday, you'll pay $697, which is almost 50% off of that price. So of what would be your regular price. So just want to mention that I'll talk about it later for anybody who comes in late, probably bring this up briefly. But just wanted to point it out and let everybody know that we are going to run this for the next 5 days. So if you missed out back in May, or maybe you're a new member and you're on trial right now, but you like the service, next 5 days is going to be a great time to sign up. And one question always comes up: what if I'm on my 30-day? What if I just started a 30-day trial? Do I get the rest of my trial? Absolutely. Your 14 months will be added on to the end of your trial period. So you're not losing anything if you're 15 days into your trial. All right. Let's go on to market update. So why do I think we're in a secular bull market? Well, I think this big picture chart, and those of you who've been around for a while and follow me for a while have seen this probably before, but this is a 100-year monthly chart of the S&P 500. I believe our stock market goes in cycles. I think we go from over-regulation to under-regulation. We just kind of go back and forth. And so we go through cycles where it's very, very positive for stock prices. And we also get, almost generational type rotation between the bond market and the stock market. And so it's the combination of all these things that send us into what I refer to as secular bear markets, where you can see 12, 13-year periods where the S&P cannot set a new high. Notice, we topped here in 2000, and I don't know, maybe we went just slightly above. I don't know exactly what the highs were, but basically we had a double top, went back down, we put in a little bit lower low, and then rallied. But it wasn't until 2013 before we had a definitive break above 2000 high. That's 13 years. I mean, we've been in a bull market now for 10 years, 11 years. We get spoiled, because we just keep going up, setting new records. And after a while, we kind of forget how bad it was during the secular bear market. And then we let our guard down. We get very complacent and everybody's jumping in. And then when you run out of buyers after about 20 years, then you go through the cycle. It's a rinse and repeat. And that's what we've seen. You can look back into the 30s and 40s. Of course, this, coincided with World War. World War II was 45, I think, somewhere around there, maybe earlier in the 40s. I don't remember exactly. But anyway, we got through this period, and you can see that double top. And we made the breakout in 50, 51, probably 50. And we went until about 69, 18 years. Topped, went down. Here we put in a slightly higher high and then a slightly lower low. Look at this right here. Went down and put in a lower low, put in a slightly higher high, and then pulled back. I mean, these things set up fairly consistently. And so 2000, 2013, same thing. Pulled back, went up, might have gone a little higher, definitely went a little bit lower, and then finally broke out. But these patterns look very similar, I think. When you get into a secular bull market, you can see the patterns are pretty similar as well. Now, these red circles, indicate, they coincide. I don't know if every one of them coincides with a recession, but I know several of them do. But really, it's just to highlight cyclical bear markets within a secular bull market. So you can have short-term bear markets within long-term bull markets. Very normal. Doesn't feel normal. I mean, in 2018, when we had the trade war and we went down 20% in 3 months, that didn't feel normal. That felt like a really bad bear market was starting. I remember a lot of folks were saying that was it. Bull market's over. Here we go. And I argued against it then. I said, that's a cyclical bear market. It's a long-term secular bull. And as hard as it was to convince people of this one, back in March, I think I wrote a stock charts article on March 13th and specifically said that I believe we're still in a secular bull market. While everyone else was throwing in the kitchen sink and, thinking that, based on all the media headlines that the world was ending and the next Great Depression was coming, I said this is a secular bull market. It wasn't because I knew anything more than anyone else. I just firmly believe we go through cycles. And yeah, we'll have periods where the market goes through some turmoil, but it's not going to last long. That's what history teaches us. That's what these circles are. We go down, but we don't really go down long, and we come back up, we set new highs. 1987, I remember 1987 almost like the back of my hand. Some things anyway. But I remember being disgusted with the stock market. I mean, this was back before I really knew a whole lot about the stock market. I was starting to develop a passion for it. I'm surprised I still have it after 1987. But that was a rough period where we fell back and then immediately came back. And I likened this collapse back in March and April, well, March, end of February into middle of March. I likened it to 1987. I mean, I was comparing it back then, looking at it versus 2008 and 1987. And to me, there was a lot more. It looked much more similar to 87 than it did 2008. And there were a lot of different reasons. But 2008 was part of this secular bear market. That's not what we had here in 87. Before the 87 crash, we had a great bull market going. We had the crash and then we came right back. 2008, we already had a stress system. We already had really bad sentiment and then got the financial crisis on top of it. Now you fast forward to 2020 and we had a great bull market, just like in 1987 before we had the pandemic hit. And this had nothing to do with the economic cycle. We were fine in February. All of a sudden the pandemic hit and you know, it is definitely a health crisis. Don't get me wrong. I'm not trying to diminish the health crisis, but it's not necessarily a stock market crisis. Everybody thought it was, but it turns out it wasn't. And now we're starting to see lots of companies already reporting great results. I mean, look at Apple and Amazon and all these companies. I mean, their earnings are crazy strong during a pandemic with interest rates near zero. I mean, you can't, I mean, it's nirvana for the equity market. And now we're starting to see other areas of the market participate. Transport's breaking out. But one of the things I want to talk about right now is because I think the long-term theme is still growth over value. Doesn't mean that we're going to be in growth versus value every day. It doesn't mean growth is going to outperform every day. And we go through cycles. And right now we're in a cycle where value is outperforming. And it might last for a little while. I don't know how long it's going to last. But I think ultimately growth will win out. And the reason I believe that is I think the economy is going to strengthen. I think that earnings growth will be greater in the technology area, probably in communication services, consumer discretionary, all the aggressive areas of the market. I look for faster growth. And with historically low interest rates, those companies are going to continue to command higher PE multiples. So I am a fan of growth versus value in the big picture. Short picture right now, that's not what we got. And we had to struggle through this mid-May to June 8th. And our portfolios struggled during this period because our portfolios are made up of a lot of growth companies. And so this past week, especially, we've seen many of the portfolios pull back a little bit. But if the overall theme remains strong here with growth versus value, I think we're going to want to make sure we still have a lot of representation there. Now, these charts are pretty interesting. This is IWF divided by IWD. So this is a relative chart of growth versus value. Russell 1000 growth versus Russell 1000 value. Now you can imagine some of the names, like the growth stocks, you're looking at Apple, Amazon, and so forth. Value, you're looking at Berkshire Hathaway and things like that. But this ratio has been going higher. Growth easily outperforming the value. Now look at this next chart, and it's going to look almost the same. That's the next chart. Didn't it look? Let's just quickly go back and forth. Not really a whole lot different between these two charts, right? There's your IWF, IWD. Here's your NASDAQ 100 versus Dow. It looks almost identical. And it's because you got a lot more growth stocks, obviously, on the NASDAQ and more value-oriented stocks on the Dow. And so there is the correlation. Now, just look at the last 5 days. Here's a 5-day, 10-minute chart. So this would have been last Tuesday, Wednesday, Thursday, Friday, and today. Here's the Russell 1000 growth. So this is your IWF. See what it looks like here? Now I'm going to type in the NASDAQ 100 and take a look at the chart. I mean, it looks like the same chart I just showed you. Now let's take a look at the IWD, which is going in the opposite direction. It's going higher. And now let's take a look at the Dow. I mean, you see the same, it's the rotation. And, if you're in growth stocks, here's the problem. If your timing is perfect and you can get out of growth and into value just at the perfect time, ride value up and then swing back over into growth, and you time it all perfectly, you can make a fortune. I'm not that good, believe me. And so, we're not going to, on our portfolios, we're not going to be trying to get in and out based on these sudden shifts in the market. Our belief long-term is the market's going higher. We're in a secular bull market. Interest rates stay low. Earnings rise, and growth will be the best place to be. That's kind of the theme. But that's not to say we're not going to have weeks or even 2-3 week periods of value outperforming. And when it happens, it happens. Again, we're not going to try to. Now, if you're trading, then yeah, you can try to time these different things. I mean, right now, those Dow stocks are absolutely in favor. I mean, we've had airlines, cruise lines all of a sudden waking up. Do I think that, would I buy an airline today if I know I have to hold it a year, or would I buy Apple? I'm buying Apple. I don't know what the airlines are going to do. I'm pretty sure Apple is going to keep growing. So anyhow, wanted to point that out. So let's move on to the portfolio results and summary. Well, the first thing I want to do is talk a little bit about the portfolios page on our website. So if you're not a member, if you are a member of EarningsBeats and you come to the portfolio page, you can check out the portfolios, and I talk a little bit about each one of them. And, maybe some of the things you should be thinking about. I do want to say, before I get into any more of this on the portfolios, I think it's really important for everyone here to understand, we, and me personally, I am not a registered investment advisor. EarningsBeats.com is not a registered investment advisor. We do not give advice. We can't. We're not legally able to give advice. We don't manage anyone's money. We have no idea what risks are appropriate for each of our members. There's no way for us to tell that, member A and member B exactly what they should be getting into. I mean, my background as a CPA, I mean, I was around lots of folks that did financial planning, and you go through a whole process in evaluating risk and what people, what their goals are. And I can't possibly know what to do, whatever all of our members should do. What we do here is we provide research and we provide education. And the whole reason behind these portfolios is not to say, hey, everybody jump into the portfolios. It's to show you that our methods work. That's the whole purpose of doing this, is just to show that what we do and what we talk about, what we teach works. These are things that you should be incorporating into whatever your strategy is. That's the whole idea. So I don't have to say it, it's boilerplate, but please consult your financial advisor before you decide to purchase any securities, whether they're in our portfolios or in our chart list or not. You're taking on the risk. And obviously, you might sit back and say, well, you're saying these things are great, you should back it up. Well, I can only give you the results. We track it. I think that our strategy is a sound one. But again, I have no idea if you're on fixed income and you're, using money that could be, you might need in 5 or 10, 15 years, or if this is a college fund that your child's going to be using in a year from now. We have no idea. So we can't possibly address the risks that each of you would, should take or should consider taking. So I always just want to mention that, because that sometimes gets overlooked. And I do try to point it out as often as possible. Everyone's got to be responsible for their own decisions. But, I try to teach the things I've learned over the years, and I've learned a lot, and I've paid a lot of tuition in the market to learn a lot of these things. And so if there's one thing I'd like to be able to do is just pay it forward. Things I've learned a lot of stuff from John Murphy, especially with intermarket relationships and how that impacts, the sustainability of a bull market or a bear market. And I simply just want to pass things along. That's why we do what we do here. And that was one of the reasons I came back to EarningsBeats, after a year, because this is a little bit more specific what we're doing here. I think we can get a little closer to our members and have these, webinars. When I was over at Stock Charts, I was doing shows, but I wasn't doing webinars where we were constantly getting together with our members to go over things that we're learning about the market, just like we did during the pandemic when we created the War Room. Everybody had to stay at home for a while, and we had these Friday afternoon war rooms because we wanted to help our community. Those were things that we can do kind of on the fly as our own company. All right. Anyway, so I just wanted to make sure. Obviously, I can't guarantee that the performance we've had to date in these portfolios is going to be the performance we see next year or the year after. There's always risk. There's risk in any investment you make. I've been in mutual funds before where the mutual funds had a great year, and then I hold and the next year it's down and it's underperforming. I mean, it happens to everybody. Hopefully, following relative strength, we've got a pretty good track record, but again, everyone has to take their own risks. So under each of these headings, you can see the CC portfolio. This was a character change portfolio. We did it for 2 quarters. First quarter, it underperformed by, 8 percentage points, something like that. And the second quarter, it kind of went along with the S&P 500. Just didn't like the way it was performing. We're trying to continually improve our services. So that was disbanded after the first 2 quarters. The model portfolio started in November of 2018. And so you can go down under the model portfolio and you can go back and look at performance and the stocks that we had in here each quarter. So you can just kind of scroll through to see what each stock did. And so we've got that information there for you to take a look at. You want to check out the aggressive portfolio, same thing. Now this one started in May of 2019. So this is a little over a year, but you can see we had a great quarter the first quarter. Second quarter, we underperformed by 8 or 9 percentage points. Third quarter, we were back up by 1.5 percentage points. Then we were up by 14 percentage points. And now in the current quarter, I think we're up again. I don't know how much, maybe 5. Well, I can probably tell you. We can go over to the, now I think I'd have to log out. I think it's on the non-member page. But anyway, this portfolio page is there for anyone to check out. Any of our members can go in and check this out and take a look at the prior quarters and so forth. And here, and by the way, this was updated through today. So model portfolio definitely took a little bit of a hit again today while the S&P was up a little bit. And again, that's that value versus growth, that rotation that we saw. But here's the aggressive, 41% versus 17%. This is since May 19th. And then strong AD since May 19th of this year. We just created that this quarter. And this came out of the pandemic. That was the whole idea of this portfolio. And it's up about a little more than 2 percentage points above the S&P 500. The income portfolio is the one that's lagged. This one, and it was 1 quarter in particular. I could show you the 1 quarter. Is it this one? No. Yeah, it was this one. So it was the quarter when the S&P 500 took a hit. And ironically, the disappointing results came from what I would have considered. We were trying to be a little bit more conservative that quarter. I remember doing this. And so I had our first real estate stock in here. MAA that's a REIT. And I had never had a REIT in any of our portfolios, but it was paying a nice dividend. And I wanted to be a little more defensive. On February 19th, the market had run a little bit. So anyway, it turned out to be one of the worst performers. OMF, this is a financial, down 54%. This was the killer in our portfolio. So, we had a really bad quarter, and we were down 7 percentage points versus the S&P. And that essentially is where we now stand. We're down about 7.6% or 7 percentage points. So it was mostly due to that 1 quarter. But hey, anyway, the model portfolio though has beaten in every quarter but 1. So when we go back here, first quarter, 25% versus 3%. Second quarter, 3.5 versus 3. Third quarter, 13.8 versus 2%. Next quarter, this was the only quarter we lost. We were down less than 1%. The S&P was up almost 7%. So definitely a bad quarter there. Next, we were up just slightly, 0.5%. Next quarter, last quarter, we were up 17%. And this quarter, last time I looked, we were up probably about 14%, 14 percentage points. And here's the stocks that we have currently in our model portfolio. Apple, CDNS, Shopify, and that's Cadence Design, by the way. So that's a software. This was one of the few times, and I actually said this at the beginning of the quarter, we took a little bit more risk because we really liked the software group heading into the last quarter, and we said we were going to put 2 software stocks in our portfolio. So for the first time ever in any of our portfolios, we had 20% in one industry group, but split among 2 different stocks. But both these stocks have been great performers. CDNS has done well, and so has Shopify. Then we got Tesla. And by the way, if you listen to the recording I did back on May 19th when we announced our top 10, I said at the time with Tesla, I wouldn't be surprised if it was 1,500 or 1,600 in 3 months. That way, it was 808 at the time. We went up and hit 1,800. And now, of course, Tesla's pulled back some. But this is a stock that's growing its earnings very rapidly, beating estimates. If they continue to do that, 1,400 is not overpriced. I'll tell you right now. Wouldn't be surprised to see Tesla in another 6 months or 3 months even. If the market's strong, I wouldn't be surprised to see Tesla up 2,000. So I still think Tesla goes a lot higher. Regeneron Pharmaceuticals, one of the biotechs working on a vaccine. Zoom, of course, has been very strong for us. Chipotle, even though restaurants went through the whole pandemic, Chipotle remains a leader, has done pretty well. Activision's done well. Zixi, this is actually Zymex, I think is the name, or Zynex. But ZYXI was doing great in the portfolio. It was up to $30, and now it's pulled back. I think it's about 17.5 or something. So it's definitely given up its gains. And then the last one's MTSI, which also has been a strong performer. But this is our current list right now. And if, I'll bring it up in a little different format here. Here's the chart list where I keep the model portfolio. This is actually in my account that I use over at Stock Charts for my shows and stuff. So this might not be the exact same title and so forth that you see when you download from your account or into your account. But these are the 10 stocks. These are the 10 model portfolios. Model portfolio stocks. And what I've done is I am showing the 3-month period. So I'm showing you performance over the last 3 months so you can get an idea. Now we had the selection on May 19th. So technically it was only like 2 months and 20 days ago. Maybe 21 days ago, whatever. So it's not exact, but this will give you an idea. Looking at 3 months back, you can get a sense for how well these stocks have done. Now, was every stock a winner? No. I mean, the market's been higher. I would say, ZYXI, Regeneron, and Activision, I would say all 3 of these probably are underperforming the S&P 500 over the last 3 months. But the other 7 are outperforming, and we've had a couple of really dominant stocks in here. And that's kind of what happens with these portfolios. I had a member reach out to me recently and ask if we could do 40 stocks in the model portfolio because they only wanted to put 2.5% in each stock. But that goes against really what we do here at EarningsBeats. I'm not into diversification. The more stocks you put into a portfolio, the closer and closer you're going to get to the S&P 500. It's going to be hard to outperform the S&P 500 with 40 stocks. It's going to be harder. Is it going to maybe keep your downside protected a little bit more? Yeah, but it's going to limit your upside. And if I feel like I can beat the S&P 500 by going with leading stocks, I'm just going to dilute the portfolio. If these are my best 10 stocks that I like, if I add 30 more stocks to them, they're not going to be my best 10 anymore. Now I'm going to my second tier of 10, then my third tier of 10, my fourth tier of 10. So this is the way we've done it. It's been very successful. Everybody our members can use these any way they want. They can buy all 10 when we announce the results or the components of each portfolio. They can wait and see if they get pullbacks, because many times these stocks, because they are leaders, that means they've probably been moving higher. So a lot of times folks hesitate to get into them because they've already been moving. I believe, I'm a momentum person, I believe that they're leading for a reason, and probably because their earnings growth is going to be off the charts and it's going to continue going higher. Are they going to get, pull back from time to time? Sure, market pulls back. But what we have found is that when the market pulls back and then goes again, leaders quickly resume their leadership role. And so when we saw the big drawdown in the model portfolio back in the fourth quarter of 2018, and also when we saw the big drawdown back in February, March of 2020, we saw our model portfolio make up those losses much faster than the S&P 500. When the S&P 500 started going higher again, money rotated quickly into the leaders. That's what we've seen. That's what we would expect. So anyhow, these are the model portfolio leaders. Now the aggressive portfolio. Last 3 months. Here are the stocks: DocuSign, Wayfair, Sienna, Enphase Energy. That's a renewable energy stock. Actually, that'll be, let me add the sector and industry here so you can see what we have. So here we got, here are the sectors and the industry groups. Now, one thing you'll notice, here was an energy stock because renewable energy has been so strong. But for the most part, as you look through our portfolios, you're not going to see energy, you're not going to see materials, you're not going to see real estate, you're not going to see much in the way of financials, maybe a couple. You're not going to see much in the way of industrials, again, maybe a couple. Utilities, maybe a consumer staple, maybe one or two consumer staples. But if you look back at where we were in May, these were the groups that were leading the market. And so we wanted to find stocks that fit into those areas. But if you look at the industry groups, all 10 stocks are in different industry groups. So if one industry group all of a sudden just takes a hit and the stock suffers as a result, it's just one stock. If I said, hey, my favorite 10 stocks are these 10 and 8 of them are software stocks, well, that's great, except if software gets hit in the next quarter, the entire portfolio is going to be decimated. And so that's why we try to steer clear of that. But then we got Dexcom, Seattle Genetics, Ring Central, AXTI, Everbridge, and EverQuote. And you can see the portfolio. Now, again, 4 or 5 of these, not really great over the last 3 months, but look at what the leaders do. The leaders just kind of drag the portfolio along. And that's what we're looking for. If you go into with leaders, hopefully your leaders are going to be strong enough that you're going to outperform the S&P 500. That's the goal. Income portfolio. So these, except for Apple, which has been off the charts, I mean, these you can see are a little bit less volatile. We don't have any massive losers, really don't have any major gainers above the S&P 500 except for Apple. If we pulled Apple out of this, we'd also have to pull Apple out of the S&P 500 though. So the S&P 500 wouldn't have done as well. But yeah, I mean, I think these stocks have all performed pretty well for us. And then the strong AD list, Peloton's been our #1 performer. And let me show you, when I talk about strong AD, let me show you what I'm talking about here. So Peloton, here's the AD. So you see Peloton back in February and March going down just like every other stock. But look at what the AD line was doing. As we moved down to the lows on March 16th, Peloton had fallen from $33 down to $17.50, lost almost 50% in 6 weeks. During that 6-week period, the AD line went to a new 52-week high, or a new high since the stock had gone public. If you follow the AD, it doesn't care about gap downs. The AD line is simply looking at where you close today relative to your high and low. So if you're at the top, if you're, here, let's say on March 16th, the low was 17.5, the high was 23, and we closed it on a 22.40. So you take the percentage of the closing price versus the high and the low. So maybe it's like at 90 percentile, 85 percentile. You multiply that. That's your multiplier times the volume. So let's say 0.85 times this volume gets added. Okay. Now, on many of these down days, you see long tails. Like here, this was a really bad day. This would have been March 12th. Really bad day, right? But we came way off the low and we finished right in the middle. So actually on March 12th, the AD line went sideways, even though price-wise, we probably were down, I'm going to say 13% or something that day. I don't know what it was, but probably maybe something like that. But the AD line didn't go down. Why? Because there were a lot of buyers that came in off the bottom. And then on the 16th, this huge reversal took place, and that's where we got the big breakout. So that's how the strong AD got started, and the weak AD is the opposite. Okay, just want to make sure everybody is aware of that. So anyway, Peloton, NVIDIA, PayPal, Amazon, Wingstop, Electronic Arts, Netflix, Vertex Pharmaceuticals, Slack. This one has definitely slacked quite a bit of late. And Massimo, MASI, same thing. Both of these. And you can see the scooters starting to deteriorate on some of these, but many of them have kept their strength and have powered the portfolio ahead. And again, that's the idea. That's what we're looking for. Okay, so that's the results and the summary. I'm going to talk a little bit about the design strategy of these portfolios in just a minute. But first, I want to go through and show you the sectors and industry group relative strength. This is a chart list of all of the industry groups. And the way I organize it is by having all of the technology groups start off 001-XLK. And then I've got them numbered 1, 2, 3, 4, 5, 6, 7. And then I've got their, then I've just got the description of their ticker symbol of the industry group relative to the S&P 500. I think we also have a chart list. This again is in my stock charts account that I use for my shows, but I have another account where you download from on the website. And I believe that those have not just the ticker symbol, but also the name of the industry group. So that might be more helpful if you don't know the symbols used for each one. But anyhow, I've got this numbered 1 through 7 in technology. And then you can see we move on to XLY, which is consumer discretionary. And we number from 1 to 20. And alls I do, and I do this pretty frequently, is, well, I'll tell you, one thing I do is I'll look at this view all and summary. And so right at the top, I can tell you that coal, the coal index was number 1 today. Gambling stocks were number 2. Recreational services, think cruise lines, number 3. Airlines, number 4. Aluminum. And then we got the hotel and lodging REITs, aerospace, steel. I mean, if tires down here, if you've been following the market and you follow industry groups, you know that these stocks, these groups that are leading today are stocks and areas of the market that have been lagging for months. They're showing strength currently in the near term. Now, does that mean that they're going to continue? Well, I'll tell you what, let me pull up the coal chart and you decide how much you trust this. This is the relative strength of coal versus the S&P 500 over the last 3 years. It's a weekly chart. So yes, today we had a really nice day on coal. Are you thinking that this is a great chart? I don't. Anything that's sloping from left to right and going lower is not good in my view. I want it to be uptrending. I want to see coal outperforming the S&P 500. We've had pops before. You can see we've had relative strength in the group for a week or two before, but then it just simply rolls back over again. I'm not interested until I see coal above its 20 week, which is above its 50 week. That's the configuration I want. I want the exact opposite. Right now it's below the 20, which is below the 50. I want it flipped. If I'm trying to outperform the S&P 500, how easy do you think it would have been over the past year and a half in coal? I'm saying it's probably impossible to outperform the S&P 500 by investing in coal. So I look at this chart and yes, it was the best performing group today. And you know what? If you were psychic and you knew that today was the day to be in, you'd have made a fortune in coal. But I hope you're a good psychic, because if you're in any of these other days, you probably aren't going to fare so well. So the whole idea for me is I want to see consistent strength. I don't want to see a little bit of strength short term. Gambling stocks. All right, here we go. We're moving up. We did climb back up above the 20-week, which is nice, but we have had no consistency to our strength to the upside. And you can see throughout the last couple of years, 3 years, well, 2.5 years, we've been almost entirely with the relative PPO in negative territory, because that's the other thing I look for. Relative momentum should be positive. About the only time I would have considered gambling stocks might have been in December and January, and I would have been watching to try to get this breakout, a definitive breakout. I mean, maybe we had it 1 week, but then the next week we completely fell apart again. And so if you do get into stocks that are in weak groups, the one thing I would suggest is keep your stops in play. Don't be messing around with stops. Don't hold for 2 weeks and think that, oh, maybe it's just going to come right back. I just, need to sit back and wait. Because if you get into one of these drops or one of these drops on a relative basis where the entire group is significantly underperforming the S&P 500, that's how you lose a lot of money. So make sure if you're going to take a shot with stocks that are in groups like this, you keep your stops in play, because when they roll over, they can get really ugly. Okay, now this is the intraday. This was today's action. Now, what about if we went back and did, I don't know, a month? I don't even know. Haven't even looked at these. I mean, the list is going to change for sure. Aluminum's done well over the last month, by the way. Paper's done well. Delivery services, here's one. I just wrote about it and put it in my Trading Places blog right before this event started. And I also talked about it today in the Your Daily 5, which is a recurring show over at Stock Charts TV. But look at this one and compare this relative chart to what we just looked at with gambling stocks and coal. Now that, to me, is a much more reliable move to the upside. Doesn't mean we won't show some weakness, relative weakness, because we've had just a huge move to the upside. I wouldn't be surprised to see a little profit taking at some point. But Wall Street is pouring money into this group right now. It was on a downtrend 2.5 years, but that downtrend has broken. It also broke out on an absolute basis, which I show down here at the bottom, taking out that prior high. So companies like UPS and FedEx really look good to me right now. All right. So that's a 1 month. And you could change this 3 months, go back and look over the last 3 months. Look at the delivery services, second on the list. Aluminum, by the way, second over the last 3 months. But this one was beaten down so bad. This is just an extended dead cat bounce. Maybe it continues. I think we need to watch the dollar and materials a lot closer. So this one could, maybe it's going to make that break above the 50 and that 20 crosses the 50 and relative PPO goes positive. It's all possible. I think it's maybe just a little early still. If we go into a 3-year uptrend similar to the 3-year or 2.5-year downtrend, getting in the first 2 or 3 months isn't necessary. I mean, yeah, it would be perfect if that day, if I'd said, hey, jump into aluminum now, that would have been a great call. But I'm not going to try to catch a bottom. I'm not that kind of a trader, investor. I don't look for bottoms. I let the bottoms form. I let somebody else be the hero to catch the bottom. And I wait until a group is turned around and is showing relative strength. Then it starts to catch my attention. Until then, I stick with what's working. All right. So that's the industry group relative strength chart list. So what do I do with this? Because this is a really big part of designing the portfolios. And I'll get into the whole design in just a second. But one other thing I'll mention here about this industry group relative strength chart list is that I like to go through, and I'm just going to put it in order here, because a lot of times what I will do is I'll go through and list the industry groups that I have interest in. And so I would look at this one. This is technology. This is computer services. And I would say, no, not interested. Now, I might have one stock, maybe one stock in one of the portfolios that's in this space if it is a tremendous leader, like blowing the entire computer services industry away, blowing away the S&P 500, then I might be interested. But overall, am I looking to put one of these stocks in each portfolio? Is this the kind of industry group I'm excited about? No. I mean, I don't want to get in and hold 3 months. I mean, how many times have you been able to really make money in holding 3 months? I mean, here was one period, maybe. Unfortunately, our selection period's May, so it would have been here. And we get out August 19, which is way over here. We'd have gone down. I mean, we'd had a little bit of an up move, been feeling really good, and then got crushed in the portfolio. So I want to go with areas of the market that are showing relative strength, consistent relative strength. So, you know, if we go into a quarterly period and we've got a group that's been going up for 3 years, that's the type of group I'm going to be more interested in. All right, semiconductors. I mean, right now, love this group. On a relative basis, it has not been below the 20-week moving average in over a year now. It was right at the beginning of August, last time we dipped below the 20-week relative EMA. Check out the PPO. This is what I was talking about, PPO staying above the center line. If you've been in semiconductors for the last year, you've done well. And I don't see anything to suggest at this point that I wouldn't want to stay in semiconductors. You got some great leaders out there. I can promise you AMD is going to be considered. I don't know if it'll be model portfolio or one of the others, but AMD has been a tremendous leader. Great earnings report. So then we move into software. Software struggling here over the last 5 weeks or so. But do I want to own it for the next 3 months? Yeah, I do. We've had plenty of these moves where we've come down, tested that 20-week. And to be honest, even here in the summer of last year, we went a little bit below the 20, and then we turned back up off of it. Software companies can grow their earnings really fast. And if you think back to what I talked about at the beginning of this webinar, I believe that we're in a secular bull market that's going to be driven by earnings growth and low interest rates. And not to mention a very accommodative Fed, government stimulus. I mean, the list goes on and on. If you're trying to bet against this market, you have to be pulling your hair out. And you know, even those that I would have said, hey, if I'm going to short these groups. Even those groups are starting to break out. So I think you know, trying to short this market is really a big mistake. I would remain on the long side, and I would be looking for any relative weakness in strong areas as an opportunity to begin buying into some of the best stocks in those areas. So software, this pullback, I know sometimes you're like, well, I don't know, because I think software, you know, maybe it'll keep going down. Well, maybe you get in a little bit now. And then if it keeps going down, you get in a little bit more. But what ultimately happens and what really messes with our heads is we wait. And it's, I forget the bias. I know Dave Keller over at Stock Charts has talked about it. But it's essentially, you think that this is a good time to get in, testing this 20-week moving average. And then you watch it bounce and go back up to the high. And then you say, yep, that was a good time to get in. So I'm going to go out and buy now. And that's after it's already made its bounce. We want to try to avoid doing that as best we can. You know, we're not always going to get these 20-period tests. I mean, look at software was above its 20 period, quite a bit of ways above for months at a time. You know, you can see that on the chart. So waiting for a 20-week test could mean you wait for 6 months before you get in. In the meantime, you miss out on a lot of gains. But you can be maybe a little bit more prudent about it and just buy in pieces when you get these pullbacks. Like I said, I wouldn't be surprised. I wouldn't be shocked if we got a 50-period test just because we've only had one in the last 3 years. And I wouldn't mind seeing, as long as software moves down or some of the leading groups move down and money just rotates into some of the other areas, I'm fine. Now, if the market makes a big breakdown overall and the leaders fall, then I got a little bit more of a problem. So I'd like to see software unwind a little bit in terms of its momentum, but the group still looks incredibly strong to me. Then you've got electronic equipment. I'm not going through all these, by the way. I just wanted to point out a few of these. So then you got electronic equipment, downtrending. Can you trust this? I look at it and I say no. So would I maybe find one stock in this industry that might fit the bill to go into a portfolio? Yes. Am I going to look to put 4 electronic equipment stocks into each of the portfolios? No. If I'm going to do that, I'm looking for the best groups, the groups I trust the most. And this would not fit that category. And we got computer hardware. This doesn't look too bad. Welcome to the home of Apple. But, you know, look at the group, just absolutely on fire. And they're leaders. You know, you got a lot of stocks in this area leading the market to the upside. It's not just Apple. Apple obviously is carrying its load for sure. But there are other computer hardware stocks doing very well as well. Some of those may find their way onto our portfolios. Then we got the electronic components and equipment index, been strong recently, but once again, do I trust it? Not based on the last 3 years. It's just not enough. Getting close. You know, I mean, we were making the same thing. Look back at February. If I had decided on February 19th, 2019 in the model portfolio, if I had looked at this and said, oh, this group's starting to strengthen, I want to make sure I get representation. Over the next 3 months, from February 19th to May 19th, which would have been down here, that would have been just a mess. So just because it's getting up here and starting, you know, I want to see it continue. I want to see it go up, maybe pull back, hit the moving averages, and then go up again. You know, start to show some real leadership for a period of time. Last one I'll show you here in technology. This is telecommunications equipment. And look at this downtrend. Now, we do have one in ours right now, Sienna. And so if we pull up Sienna, you will see that with Sienna, we've got this move up. It looks great. And if I pull up the relative chart, though, you'll see Sienna is performing extremely well relative to the DJUSCT, which is telecommunications. It's easily outperforming the S&P 500, but there's the group relative. So I have one stock in our portfolios that's part of the telecommunications group. I don't want to commit too much to it because this stock was incredibly strong heading into May 19th, right here. I mean, you can see we're above the 20, making another breakout. We were trending higher. Even at the time, the telecommunication group was trending higher, and we were starting to turn back up here on a relative strength basis. So, you know, I kind of talked myself into it, but Sienna's continued to do well. Why? Because it's a leader. It broke out to another 52-week high recently versus its peers. That's why we want to stick with leaders. All right, so that was telecommunications. Anyway, I just walked you through that one sector, technology, but I do that with every chart in this chart list to figure out which are the groups that, as we go into the top 10 stocks webinar, which are the groups do I trust the most to outperform the S&P 500? And then once I've figured that out, I want to figure out, you know, maybe the 5, 6, 7 that are heavily represented in our portfolios. So there's going to be probably 5, 6, 7, 8 industry groups that are going to have multiple stocks. I want to figure out what those are. And then I look for stocks in other strong areas. And then finally, I just look at high scooter stocks that are maybe in some of the weaker groups. And that's how I would have run into Sienna. All right, let's move on to the portfolio design strategy. I did just talk a little bit about it with the industry group relative strength. And by the way, I look at the sector relative strength charts as well, in addition to industry group. So what about portfolio design? How do we do this? Well, this all started back in November of 2018 when members, you know, we started doing the strong earnings chart list a ways back. I've been using it now for 6 or 7 years. I don't remember how long it's been that we've been actually showing it and providing it to members, but I want to say it's been a couple years, 2, 3 years. But anyhow, the chart lists would be annotated and given to members, and the members would look at them, and I would get feedback, and people would say, well, you have 300 charts on here. You know, how can can you narrow it down? You know, I don't want to try to decide which of these 300. I can't buy all 300, so what do I do? And that's really how this whole concept of these portfolios began, is that I looked through the 300 and I said, okay, these are the 10 I really like. But when I first did it, I had many of them in the same industry group. And I was like, well, I don't want to suggest to somebody or say to somebody, hey, I really like these 10 stocks when 8 of them are semiconductors. Because then all of a sudden semiconductors have a pullback and the portfolio gets slammed. So at that point I said, well, let me look at different industry groups. And so for the first 2 quarters, the model portfolio was the only one we had. So into the early part of 2019, that was it. And I remember, we were starting, I was writing about it while I was over at Stock Charts, and the fact that I was putting this portfolio together, and just started communicating some of the things I was looking for. And we started to get a little bit more momentum in terms of people interested in EarningsBeats. And again, this was before I announced I was leaving. But that was one of the reasons why my daughter Erin came over and helped us. I think it was in June of 2019, a little over a year ago, because we were starting, she wanted to get out of public accounting. Can't blame her there. And we needed a little bit of extra help because I was only consulting with John at the time. I was full-time over at EarningsBeats. So Erin came on board and was starting to help us. And it was in that May 2019 time frame that we decided to launch both the income and the aggressive portfolios. And that was born out of members saying, hey, I really like the model portfolio, but what about an aggressive portfolio? You're giving us Apple and some of these other companies, and how about an aggressive portfolio? Do you have 10 of those names that you really like? And so there was the aggressive portfolio. And then we had other members who were saying, I'm not comfortable with a lot of these companies because they're volatile, and I'm really trying to live more on a fixed income, and I would want more portfolios that maybe pay dividends. And there you go. There was the income portfolio born in May 19th, 2019. So that's the 3 portfolios that we had going over the summer of last year. And that's when I announced at that point in August that I was returning 1 year ago tonight. And actually, before we get into any more of this portfolio design strategy, just let me take a minute to anybody who came in late. I want to make sure everybody realizes we have an anniversary special going on. So I'm really excited. I mean, we've had so much support over the last year. I can't thank you all enough for the support that you gave me, not only when I was at Stock Charts, but when I came back to EarningsBeats. So many folks came back and joined our community, either as digest subscribers, our free newsletter, or came on as a trial. And, many of you have signed up, been monthly members or maybe annual members. Some of you tried the service, left. And even those of you who have just been in the community and haven't tried the service, we realize we're not for everybody. We're not crazy. I mean, it's, we're not inexpensive. I think we're, priced pretty well for what we offer. But I also realize there are a lot of folks maybe can't afford it, don't want to spend that kind of money on a discretionary thing. That's fine. I really appreciate the support, no matter what kind of support you've given us over the years. But I want to give back. And so this whole anniversary special, normally when you go through EarningsBeats after your 30-day trial, you're going to get charged $97. If you haven't told us you want to upgrade, and we ask you, we give you notice on if your trial's about to expire. We don't try to sneak in and try and get $97 from you. We only want you to be with us if you like our service. But if, let's say you stay on board and you just pay our monthly rate for 12 months, that's $97 a month. That's $1,164. Tonight, we're offering a 2-month bonus for an annual package. So that additional 2 months is worth another $194, 2 times 97. So 14 months of our service at the regular price would be $1,358 for the next 5 days until Saturday's webinar. We're going to do a webinar on Saturday talking about all the research that we put together and how you can best use it. Until Saturday, for the next 5 days, you can give it some thought. But the annual membership will cost $697. That's the normal price, but we're giving you 2 bonus months. Now, I know a lot of folks charge $97 a month, $1,164, something like that, but they'll offer you an annual special and take $100 off or $200 off. Our annual already is a pretty good deal. And by the time we throw in 2 more bonus months, that takes us down to $50 a month, roughly. We're talking about 14 months and about $700. That's $50 a month. I think we provide a lot for $50 a month. The other thing I want to mention, and I'll just mention this briefly as well, because we've had some discussions about it at EarningsBeats. We are going to break out a separate membership for professionals. Those of you who are professionals and already members, you'll be grandfathered in. But for newer members that come on board after Saturday, or at least until we announce, those professionals can also sign up with this special deal that we have. And then after that, there will be a higher professional rate. I'm not talking about anybody who's got a professional job, a doctor, a CPA, blah, blah, blah. I'm talking about a professional in the investment services world, somebody who manages money for other people. If you've got 100 clients and you're spreading the cost of us, our service among 100 clients, a little different than an individual who's coming in here looking for some help. And so that's the reason why we've now broken it out into a separate plan. So you'll see that on our website if you're a professional, but we will honor this. We've been honoring professionals at this rate up until now. We'll continue to do that for the near term. And I'm just saying near term loosely because I don't know exactly when. Maybe Saturday, maybe after the August 19th top 10 stocks. I don't know. We'll think about it. But anyway, this is a great time to join. So anyway, I just wanted to point that out. So let's get back to this last portfolio design strategy. So the whole idea with the portfolios, and if we just pull up, let me pull up the portfolio. So again, what we're trying to do is we want 10 stocks in 10 different industry groups. Now, I said earlier, the model portfolio did make the one exception where we had, and let me get this up here. We did have one exception where we have 2 software stocks. Did that intentionally. We announced it when we did it. But we felt so strongly about software going into this last quarter that we wanted to have a little more representation in that area. And with 2 different stocks. So it wasn't like one stock took up 20%. And then there again is your 3-month performance. But you can see both our software stocks have done very well. So it turned out to be a pretty good call. So when we're talking about designing these portfolios, there are a couple things I want you to keep in mind. First and foremost, we're trying to find leading stocks in leading industry groups. That's the #1 priority. Now, you can't find, if you're trying to diversify into different industry groups, it's hard to find every industry group that's just flying relative to the S&P 500. But we do want, for the most part, those that are outperforming. With, say, relative PPOs on those relative strength charts that I showed you earlier. The relative PPOs, I like to be above 0. I like for the relative price action to be above the 20-day, or excuse me, 20-week EMA, which is above the 50-week SMA. I like to have that configuration because any relative strength line can point higher just after a week of strength. I want relative strength that has been sustained for a while. And in order to do that, you have to have a relative PPO above 0 and the relative price should be above both the 20-week EMA and the 50-week SMA. Generally, there's only going to be 1 stock per industry group in each portfolio. The stocks in these portfolios are held 90 days, 3 months. We are going to get into our new stocks on August 19th, and we will not sell them under any circumstance until November 19th. And I'll, every quarter, get the same emails every once in a while from members. Should we have a stop in? And I'm going to say this, just like I've said every quarter. You decide what you want to do. If you want to buy the portfolios, you want to get into them, that's fine. You can do whatever you want. You can place stops. We are not going to place stops, and I'll tell you the reason. We're essentially, we've got chart lists. We've got a lot of things for folks who like to trade frequently. We wanted to develop something in our service that would benefit those who maybe can't follow the stock market every day or don't want to follow the stock market every day, but they want to benefit from our work. And so the portfolios were one way to do that. We split them up. Each portfolio has 10 different stocks, generally speaking, 10 different industry groups, and they're held for 90 days. So you don't have to go in and make changes and adjust stops and do this. And you just hold them. At the end of 90 days, we swap them out. Some of them might stay. You know, a company like Apple, I may not want to release Apple. Apple might stay in both the income portfolio and the model portfolio. I mean, Apple's a trooper. It's one of the, you know, what other stock would you rather have your money working for you on than, say, Apple? Anyhow, so that's the whole idea. If you want to put stops in, put stops in. We tried that a couple of times a few quarters ago, and we had a couple stocks get stopped out. But unless we're going to get back together again and talk about, okay, well, now we're going to replace it with this stock over here. And then the whole question comes up with, okay, well, if an equal amount went into stock A, let's say you have a $100,000 portfolio and you put 10,000 into stock ABC and it lost 40%, you got stopped out. So it went down to 6,000. Now what do? Are we just putting 6,000 into the new company? Or are we going to reallocate and start over again? It's just going to, the whole idea behind the portfolios is we want it to be simple. And this is as simple as it gets. Every 3 months, here are the stocks that go in this portfolio, this portfolio, this portfolio, and this portfolio. See you in 90 days. And that's it. I can promise you, if you are a trader at heart, if you're really into following stocks and you're looking every day, holding on to this portfolio is going to drive you absolutely crazy. It did me. I couldn't stay in it for 90 days because I get that question. Well, are you investing in these portfolios? I'm investing in the stocks in these portfolios. I'm trading them, but no, I am not holding them 90 days because it's just not my style. I tried to. I wish I had. I wish I had the model portfolio this quarter, just held it. I'd have done better than I did in my trading account, probably. I haven't gone back to look, but it might have been better than my trading account. But it's, again, I follow the market every day. I'm doing shows. I'm writing a daily market report. When I do have time, I like to trade. It's not in my DNA to buy into stocks and hold under any circumstances. I don't like mutual funds. I don't like ETFs for the same reasons. What I do is I try to take advantage of short-term inefficiencies in the market. And that comes down to short-term trading because there aren't inefficiencies in the market long-term. I mean, if a company's reporting great stock, earnings quarter over quarter, year over year, and interest rates are favorable and the Fed is dovish, stock's going to go higher. That's the way the market works. But in the short term, you might get a gap up and then a 20% pullback. And that's the part that intrigues me, is finding a leader that gets that pullback and hits support. All right. So again, we are holding. The portfolios are being held 90 days, no stops in play. You can do whatever you want with them. I think that this adds to the consistency. I think this adds to the transparency, and it adds to the simplicity of our portfolios. And I think is just, quite honestly, much more appealing for people who want to be involved in the stock market but don't want to trade every day. The other thing to keep in mind is every stock will generally be held through one earnings report. I guess it's possible that one stock could report its earnings on, say, August 17th, which is 2 days before we announce our earnings. And I might like it so much, I put it in the portfolio. And then come November, maybe it reports November 20th, which is the day after our portfolios end on November 19th. So I guess it's possible that a stock would not report during the time that it's held in the portfolios. But generally speaking, you need to be prepared for every one of these stocks reporting earnings. Thus, if you're in the portfolios and you're holding through one earnings report. The offset there is you're holding 10 stocks in a portfolio. So what are the chances that all 10 will report disappointing results? I mean, I guess it's possible, but probably not likely, and certainly hasn't been the case in my experience since we've had these. The expectation with these portfolios is that our relative winners are going to carry the portfolio in total performance and hopefully to outperformance of the benchmark S&P. And as you look at this chart and the summary table here, I think that's exactly what this is showing for this quarter. Now, I do not expect to have 6 or 7 stocks that are just crushing the S&P 500. That would be nice to be able to do this every quarter. I would not expect this. We've had other quarters where that has definitely not been the case. So, excuse me, if you've been in this portfolios or in our portfolios for the last 3 months, congratulations. But at the same time, I would not be, don't set the bar that high. We got a lot of really good money managers that would absolutely, be, I don't even know the right word, but they would be absolutely thrilled if after a year they were outperforming the S&P 500 by a percentage or two. You just want to beat the S&P 500. So to do it to the level that we've done it over the last 21 months in the model portfolio is not something I would expect. Maybe it keeps happening. I don't know. But I do like our strategy. I like what we do. All of our portfolios, I want to make sure everyone understands this. When we do the selection, I do the selection process during the day on the 19th. So August 19th, during the day, I am picking the stocks. Wherever they close at that day, I'm not picking any stocks that are going to be reporting earnings after the bell. Wherever those stocks close on that day, that is the price that we are using for our portfolio performance. Now, we don't have the event till after, so then members would have to buy at the opening price the next day. So I've had members say, well, that's not right because we're buying it the next morning. You get it at the close. All of our studies that we've done going back, it really doesn't matter. Keep in mind, too, that we announce on the 19th of the month, and the 19th to the 25th historically is the worst time of the calendar month. So there's a good chance that you might be able to get in. In many cases, this has been the case. Our members getting in the next day, get in cheaper than we do at the 19th close. We don't pick and choose. Well, we'll take this one 19th close, this one 20th open. We do them all. We're just consistent. Again, we're trying to be consistent, trying to be transparent. One other thing, primary objective of all of our portfolios is to beat the S&P 500. That's our objective, our primary objective. If we go through the next year and we haven't outperformed the S&P 500, I'm not going to be happy. I'm going to be trying to do something to tweak, because to me, that's the most important thing. Otherwise, we could just put our money in the spider and go golfing. There's no reason to have these portfolios. I would say that the riskiest and most volatile portfolios are going to be, I would say, aggressive and strong AD are going to be the two most aggressive, and model right behind it. And I think the one that should have less volatility, and with the one exception of that bad quarter that we had last quarter, definitely has had less volatility, is the income portfolio. Now, I can't guarantee that's going forward, but I would say based on how these portfolios are put together, I would expect that the income portfolio to have the least amount of risk and volatility. The income portfolio stocks will all pay dividends. And I'd like to have an average dividend yield in that income portfolio of at least 1.5%. That's the goal. Now, as prices rise, dividend yields fall, so maybe it falls a little bit, but again, that's the goal. 1.5% would be nice. Drawdowns generally will be much milder on the income portfolio because of the lower level of expected volatility. The other three, we do a weekly portfolio report, and we show the cumulative results of each of our 4 portfolios since inception versus the S&P 500. So you can go back and you can check that out on Sundays when you get our weekly portfolio report to get a sense of how much our portfolios drop on a percentage basis during weak periods, like Q4 2018, the trade war, like the end of February, early March. These portfolios are not going to be magically immune to the market selling off. I can promise you that. If the market takes a big hit, these portfolios will take a big hit. We're not trying to time it. We're not trying to say, hey, step out while the market's weak and get back in 3 weeks later. That's not the purpose of this. This is really it. This is, relative strength and technicals and fundamentals meet buy and hold. So it's really like the marrying of a lot of different strategies. The strong AD portfolio, it was selected in this last quarter from a combination of rising AD lines and scooters above 80 at the time of selection. I'm not sure exactly whether we're going to keep those same criteria yet at this quarter, for this selection, but I'll certainly let you know what the criteria is at the time of the event, because this whole strong AD versus weak AD thing, it's been now 5 months since back in March, and we've seen home builders, which were part of the weak AD. Home builders have come to life. They shouldn't even be on the weak AD anymore, but we haven't changed those portfolios, or those chart lists, I should say. So there's some things that have changed over the last few months. So we'll be looking at that, trying to decide what to do there. But I will say this, the strong AD portfolio was the only portfolio where the stocks did not come from our strong earnings chart list. And so right now, our strong earnings chart list, and I'll pull this up for you. This is where 3 of the 4 portfolios will come from. They will come from stocks on the strong earnings chart list. And I can tell you that a lot of these highly ranked scooters are going to find their way onto these chart lists. I'm not going to say every one of them, but some. I mean, like you've got NVIDIA and AMD, 2 highly ranked semiconductors. I like both companies. NVIDIA is going to be reporting again soon. So they're going to have to beat top and bottom line to even be considered. All right. AMD has already reported and is very strong. But you can see the group here, these are leaders. And a lot of them are going to be on the portfolios when we go over those next Wednesday. Let's see. Again, I'll just emphasize, you can own these portfolios entirely, one portfolio. You can have all 4 portfolios. You can have a mixture of portfolios. You can own none of them. The choice is yours. We do the research. We basically provide what we, why we like these, how we go through the process. Here they are. You might say, hey, this is too risky for me. If it's too risky for you, don't do it. I'm not encouraging anyone to take risks that they don't want to take. It's your money. It's not my money. So you got to do what's comfortable for you. But we do have a process that I think works. Certainly the results to date show that they've worked. And even if you don't want to buy and hold these portfolios, like I said, these are some of the best stocks to trade. When you get a few days pullback in many of these stocks, they tend to go back up to new highs. That's what leaders do. So keep that in mind. And so this is a strong earnings chart list. And if we pull this up in edit mode, it'll tell us we have 326 stocks on this list right now. And that doesn't include last week's earnings, because I haven't updated the list for last week, or this week, where we'll have a lot. So between now and this weekend, probably over the weekend, I will be adding and putting out new strong earnings chart list, strong future earnings chart list, raised guidance chart lists, and short squeeze chart list. All 4 of those will be updated probably by Sunday of this week. It's a lot of work, but it's worth it. I use it for my trading. And like I said, members at EarningsBeats literally just go right into the website and are able to download. So if we go in here, I haven't shown you that yet, but if you go into the chart list, once you're a member, here's the chart list that we have. You can literally click on the link. Now I've already done this, so it's probably not going to ask me for a password, but when it asks for a password, you use the one that's given right here. Don't use your stock charts password. Don't use your EarningsBeats password. Use the passwords that we provide next to the chart list. But what I would do is go in and copy it and then click the link. There'll be a box. Well, it does come up. So I have to go in and I put in the password. I paste it and I unlock the list, and there it is. Now, if you're not a member at Stock Charts, you will get the list and you'll be able to do this. There's Baidu, there's International Game Technology, there's Dicom Industries, there's NetEase, over 300 stocks. You could go through one by one like that. Also, if you're not a member, there's probably a bunch of ads showing up on this page that you don't have if you're a member. Now, if you are a member and you download this, the first time you do it, you would say save to a chart list, and you would click on new list, and then just type in. You could use what we have here as the default, or you could just type in, you know, whatever it is you want, however you order your things, you know, AAAA, strong earnings. I don't know. I think they do alpha, or I think they do numeric before alpha. So I think if you have something starting with numbers, it's going to be alphabet. It's going to be in order before your alpha list. But I always use numbers. So I don't know. Maybe you use, you know, 1,000, 1,000 strong earnings, and then you save results, or you know, whatever, however you want to. However you want to label it is up to you. Now, let's say you've already done this. You've already downloaded the strong earnings chart list, and next week I come out with a new one. When you go to our website and click on that link, then when you come here, you can simply say replace list. And then you go and you find your list. So I would go down and I'd find my strong earnings, and I would save results, and it just overwrites your chart list. And if you've got scans that are saved against a certain chart list, you don't want to change your chart list number. You want to keep that the same. And we have a YouTube video that talks about setting your account up. And it took me, I took one of our customer service folks, client services coordinator, Abby. We got her an account from Stock Charts, and I set up her account, and I recorded it. So you can go in and you can see, and I think that's over on YouTube. But I set up not only her chart lists, all 10 of them, the portfolios and the chart list, 4 portfolios, 6 chart lists, but I also saved the scans from our website, because that's the other thing, that if we go back here and you look at the scanning strategies, we provide some of the code you can use to scan over at Stock Charts. High volume scan, and then we got a downtrend reversal scan that you can use, but there are 5 of them. I saved all of those into her account. Took me a total of 18 minutes, I think, for the entire video, and I was talking and doing a bunch of other stuff. I think probably you could take this stuff and literally have your account set up with everything we do in 10 minutes. And it would probably be the best 10 minutes you ever spent organizing. So anyway, that is most. Let me see if there was something else I wanted to do here. Now, I think that's pretty much it. The one I will say that, you know, some of the folks that work here at EarningsBeats will own these portfolio stocks from time to time. So that, you know, we can't announce every time we're going to buy or sell a stock. We talk about so many stocks. When I do buy, or when I do talk about a stock in the daily market report that I own, normally I will, if I remember or I think about it, I will put in there and disclose it that I own it. So I do try to disclose when I own a stock if I'm talking about it. But let's see, I think that is pretty much what I had for tonight. Let's see. Yeah, so I don't think there was anything else that I wanted to go over. So I don't know, John, I will just say that the draft is next Wednesday. So that is the day that we will come in at 5 o'clock. The time will be 5 o'clock next Wednesday. And not going to spend a whole lot of time going through all the strategies and stuff. That's what we're doing here tonight. We're going to get pretty quickly to the draft. And I look at it like the NFL draft, except we have one major advantage over NFL teams. NFL teams, once they pick a player, nobody else can pick that player. We've got thousands of companies that we can invest in. Why not get the 10 best and put them to work for you? That's the whole idea. And so when we go through the draft, we'll start off probably with the strong AD or the income and work our way up. And the last 10 that I go through will be the model portfolio. But that will be next Wednesday. The other thing I want to say is that this Saturday, we're going to have another event, and it is basically the research engine at EarningsBeats.com. I just want to walk everyone through some of what I talked about tonight, but I want to do it in more detail. I'll show you how to run some of these scans. I'll show you some little tips and tricks, how I use these these chart lists to quickly zero in on some really good trades, and how a lot of times I'll pull things up to write about in the daily market report. But we've done a lot. We've added a lot of products and services over the last year, and we're looking to add more. Anything that we can come up with. If you have an idea, something that you think would be great, maybe it's something that we can do. We'd love to hear from you. Always want to try to respond to our membership. But that is it. So hopefully, if you're not a member, we'd love to have you come join us. We have a 30-day trial. It's $7, but it's fully refundable. You'll get your $7 back within a week. So you essentially have a 30-day free trial, and you get everything that I talked about tonight for free, except that relative strength chart list on the industry groups. Everything else that I talk about, you get as part of a 30-day trial. And if you check us out, or if you're already on trial and you decide that you really like this service, I would not wait past Saturday. Lock in 14 months at $697. We did it in spring. I'll tell you, we'll probably do it in the fall. That'll probably be the normal. We'll do it spring, fall. But with today literally falling on the 1-year anniversary since I left Stock Charts, I thought this would be a great time just to bring it back for those of you who are thinking about it, or maybe that are on trial, or those of you who might want to take a trial. All right, John, anything else?
I was just thinking the other thing that differentiates us from the NFL draft is we're virtual. We don't know if the NFL is going to take place, but we'll keep going.
Yeah, there's probably one other difference too. They deal in billions of dollars. That's
true. But you know what? We deal in trillions, the large market caps.
Yeah, we deal with Apple.
Yeah. All right. Great job.
Yep. Yeah. Hope everybody enjoyed it. I'm assuming you took care of questions that came in, John, or any questions?
Nope. We're good.
Okay, cool. All right. Yeah. Love to have everybody, sign up. I think we have a great service. We've gotten tremendous feedback from our membership over the years. We're at record high in terms of membership. Really want to thank everybody for supporting. It was a tough decision leaving a year ago, Stock Charts. No doubt about it. But looking back, and if you had told me a year ago there was going to be a pandemic and the market was going to tumble 35% in a month, I would have said, no, thank you. I'll just stay here at Stock Charts. But, we managed. And again, a lot of it was due to all the support that we got here from our members. So thanks all of you. And hopefully, if you're not a member, you give us a shot. Take care, everybody. And remember, we got a lot of events coming up. So make sure you check out the calendar. Take care.